Welcome to our deep dive. Today, we're pulling back the curtain on a company that's really fundamentally changed how we move, how we get things delivered. UberTechnologies, Inc.
That's UBER.K for those following along.
Right. And just try to wrap your head around the scale for a second. Their platform, it handles something like 34 million trips.
Yeah.
Every single day.
Wow.
Yeah, I mean, that adds up to over 11 billion journeys in a year. Sounds like science fiction, but, that's just Uber's operational reality today.
And like you said, it's so much more than just rides these days. When we talk about Uber now, we're looking at this global technology platform company. It connects consumers with providers across, three main areas. You've got mobility, that's the ride-hailing most people know.
Yeah.
Then there's delivery, which is frankly massive now with UberEats, doing food, groceries, you name it.
Right.
And then freight, connecting shippers with, trucking carriers.
The footprint is just staggering, operating in, roughly 70 countries or 15,000 cities worldwide as of early 2025 anyway.
Yeah.
There are a serious large cap player, a pivotal force in that whole on-demand or, gig economy.
Mm-hmm.
It's undeniably disrupted traditional industries.
Absolutely. But I think, to really get Uber today, you have to appreciate how it's evolved. It started, yes, as that pure ride-hailing disruptor.
Mm-hmm.
And the core innovation was always the tech, right? The matching algorithms, GPS, the payment systems. That was key.
Okay.
But the really critical shift, I think, was recognizing that this powerful engine could do more than just move people around. Getting into eats and freight, that wasn't just opportunistic. It felt like a strategic necessity, really, for resilience, for market access, and just leveraging those network effects built into the platform.
They're much more than just a taxi app now.
Oh, far beyond it.
Yeah.
They're a multifaceted logistics and on-demand technology platform. That's the key takeaway.
Okay, so let's dive in then. Our mission today is to take this stack of source material we've gathered and really unpack Uber's story for you, the listener. We'll trace those disruptive origins, dissect that, pretty complex business model.
Yeah, it's got layers.
Right. We'll look at its recent pivot towards financial health, gauge its competitive standing, explore what's next for growth, and crucially, understand the pretty significant risks it's still dealing with.
Yeah, those risks are important.
The goal here is really to give you a thorough, well-rounded perspective to form your own view.
And just the standard reminder, this is purely for informational, educational purposes. It's based on public data up to around mid-2025. Definitely not investment advice.
Got it. Okay, let's rewind. Start at the beginning. Like a lot of tech origin stories, this one comes from pretty relatable frustration, doesn't it?
It does. So picture this. Paris, 2008. Snowing. Co-founder Garrett Camp, he just can't get a cab.
Lean there.
Right. And that annoyance, plus apparently splitting an $800 private driver bill with Travis Kalanick on New Year's Eve, that kind of sparked the initial idea. UberCab, they called it. A way to summon a, premium car with just a tap on your phone.
Simple idea, huge consequences.
That frustration turned into a business pretty fast. Camp and Kalanick founded UberCab in March 2009. Initially, it was aimed at that high-end, convenient market.
Right, black cars.
Exactly. The beta launched in San Francisco in 2010, and interestingly, Ryan Graves was the first employee, the early CEO, before Kalanick took over later that year. Kalanick, he brought this really aggressive tech-first mindset. I mean, the early team reportedly included a nuclear physicist, a computational neuroscientist.
Wow, okay, so definitely tech-heavy from the start.
Oh, yeah. That tells you where their focus was.
And that tech focus, it just fueled incredibly rapid expansion, didn't it?
Absolutely. The name shortened to just Uber in 2011, and then they just blitzed city after city, country after country, New York, Chicago, Paris in 2011.
London, Toronto in 2012.
It was relentless, but here's where the model really changed and kind of sparked a revolution. The pivotal moment was launching UberX.
Right.
It started in 2012 using sort of non-luxury cars, but by April 2013, they opened it right up. Let drivers use their own personal vehicle.
Well, that was the birth of ride-sharing as we know it.
Pretty much. It dramatically lowered the cost for riders, right? And just exploded the potential supply of drivers. But on the flip side, it immediately ignited this intense opposition from, traditional taxi industries.
Okay.
And created these regulatory battles that, frankly, are still being fought today in many places.
And you saw early signs of that platform thinking, too, right? Even before delivery became core.
Yeah, UberEats actually launched back in August 2014. It was a small step then, but obviously grew into something huge later on.
So that period, say 2015 to 2018, that was the growth at all costs era.
You could definitely call it that. Their valuation just soared. They were dubbed the world's most valuable startup around mid-2015. But they were just burning through immense amounts of capital, expansion, driver incentives, fighting those regulatory and competitive wars everywhere.
And Kalanick's leadership style was key to that scale, but also problematic.
Yeah, it achieved massive scale, no doubt, but it also sowed the seeds for some significant problems, both internally and externally.
And those internal problems just became impossible to ignore by 2017, right?
Yeah.
Alongside all the external battles.
Exactly. There were widespread reports of a toxic culture, really damaging sexual harassment allegations from Susan Fowler, a former engineer.
I remember that.
Yeah. And controversial tactics like the Greyball program, which was apparently designed to evade regulators. These scandals just built up, and it all culminated in Travis Kalanick resigning in June 2017.
It's a complicated legacy, isn't it?
Very. Visionary scaler on one hand, but the aggressive tactics and cultural issues created liabilities that just weren't sustainable.
Which brings us to the current CEO, Dara Khosrowshahi. Took over August 2017.
Right. And a completely different style. Much calmer. Overhaul the internal culture, navigate this incredibly complex regulatory minefield, and somehow steer this massive loss-making machine towards, sustainable, profitable growth.
I remember reading he even spent time driving for Uber himself.
Yeah, apparently went undercover to understand the driver experience better, led to initiatives like Project Boomerang, aimed at improving things for drivers.
And under Khosrowshahi, we saw some big strategic shifts, right? Pulling out of some major markets.
Very pragmatic moves. They exited these really costly head-to-head battles in massive markets. China ceding to DiDi, Southeast Asia to Grab, Russia to Yandex Taxi.
But they didn't just walk away entirely.
Critically, no. They kept significant equity stakes in those local leaders. It was a smart way, really, to stop the bleeding from direct competition, but still potentially benefit from the market's growth through those investments. Less operational headache, potential upside.
And alongside those exits, a clear focus on strategic acquisitions to broaden the platform.
Exactly. Postmates came in to bolster Eats. Careem expanded their reach in the Middle East. Drizzly added alcohol delivery. Transplace built out the freight side. And that recent Trendyol Go deal in Turkey pushes hard into grocery and quick commerce.
So these moves, they really highlight that strategic shift. Consolidate, expand into related areas, leverage the tech.
Yeah, it feels much more deliberate. Consolidate where you're strong, enter these high potential related verticals, and use that core technology across more and more areas. It's less growth at all costs, more focused.
They finally went public, IPO'd in May 2019.
Yep.
And post-IPO, the pressure must have been immense. Show a path to profit, prove the diversification value, manage all that global complexity.
Intense is the word. Khosrowshahi really made that shift to sustainable growth, efficiency, and ultimately profitability, the central theme.
Okay, let's unpack the business model itself. How does it actually work?
Okay, so at its heart, Uber operates this really powerful, multi-sided platform. You can think of it like a dynamic marketplace, all run by technology.
Right.
It connects three key groups. There's you, the user, whether you need a ride, food, a package delivered. Then there are the providers, the drivers, the couriers, the trucking companies.
The supply side.
Exactly. And then the merchants, restaurants, grocery stores, retailers, and on the freight side, the shippers, all orchestrated through the app and the underlying tech systems.
And this breaks down into those three core segments you mentioned earlier.
Yep.
Mobility, the original ride-hailing. How do they actually make money from, say, my trip across town?
Okay, so for mobility, they earn revenue mainly by taking a service fee or a commission from the total fare you pay. And that fare is calculated based on, things like a base rate, the distance you travel, the time it takes, plus any applicable local fees or tolls.
Okay. And delivery. Ubereats, the big growth engine. How does that revenue stream work? It seems more complex.
It is a bit more layered, yeah. And it's been a huge driver of growth. They primarily make money in three ways here. First, a commission paid by the restaurant or the merchant for being on the platform and getting the order.
Okay.
Second, a delivery fee that you, the consumer, pay. And third, sometimes there's an additional service fee as well. But what's becoming increasingly important here, and it's higher margin too, is advertising revenue.
Ah, okay. So merchants paying for visibility.
Exactly. Paying for a better placement or visibility within the Eats app. That's a growing piece.
And the freight segment, how does that fit in?
So uberfreight launched back in 2017. It essentially acts like a digital brokerage. It connects businesses that need stuff shipped the shippers with truck drivers or carriers who have the capacity.
Using tech to match them up.
Precisely. They use their technology to match loads, provide upfront pricing, handle the booking, the tracking, and the revenue comes from taking a percentage of the payment the shipper makes for moving that freight.
Now, dynamic pricing, or surge pricing as everyone calls it, especially in mobility, how does that work, and what's the goal from Uber's perspective? Because it can be frustrating.
Oh, definitely frustrating for users sometimes. So it automatically increases prices in specific areas when the demand for rides, significantly outstrips the number of available drivers.
Right.
The intent from Uber's side is to incentivize more drivers to get on the road or maybe move into those busy zones, to increase supply to meet that high demand and theoretically balance the network.
So it's a supply-demand lever.
Essentially, yes. They see it as a critical tool for maintaining reliability during peak times, even if it costs more. They have also brought in upfront pricing for riders, showing you the total cost before you book, which adds, a bit more transparency.
Okay, so across all these segments, what's the core value proposition? To start with us, the riders or consumers. Why use Uber?
For the user, it really boils down to a few things. Convenience is huge, that on-demand access, usually 24/7. Affordability can be a factor, especially comparing UberX to traditional taxis in some places, although, surge pricing complicates that.
Sure.
There's speed and efficiency, seeing your ride arrive on the map, optimized routing. Safety features are built into the app, GPS tracking, trip sharing, emergency buttons, driver screening, the rating system.
Cashless payments are convenient too.
Very. And just the sheer choice, different ride options, or that huge selection of restaurants and stores on Eats.
And for the other side, the drivers, couriers, carriers, the partners, what's in it for them?
The big draw is flexibility, right? The ability to set your own hours, be your own boss to some extent. It's an income opportunity, primary or supplemental, using your own asset like a car or bike.
Lower barrier to entry than, say, getting a taxi medallion.
Much lower. The app provides the technology support, navigation, finding demand, handling payments, tracking earnings. And Uber does offer various incentives and bonuses to encourage activity, especially during peak times.
Okay, let's talk about the network effect. This feels absolutely fundamental to Uber's model and strength. Can you break that down?
It's incredibly powerful. It's a sort of self-reinforcing loop. Think of it like this. As more users join the platform needing rides or deliveries,
Demand goes up.
Right, so there are more opportunities for drivers and couriers to earn money. This, in turn, attracts more drivers and couriers to the platform.
Supply increases.
Exactly. And with more providers available, users typically experience shorter wait times, potentially lower costs outside of surge, and better overall reliability. This improved service then attracts even more users back to the platform.
It's a virtuous cycle.
Precisely. And this cycle makes the platform incredibly valuable and, crucially, very difficult and expensive for new competitors to replicate quickly. It's a core competitive strength, maybe the core strength.
Who is Uber really targeting with this massive, sprawling platform now?
Well, initially, mobility was probably skewed towards, urban, tech-savvy folks, maybe 1845, who prioritized convenience and efficiency. But delivery has widened that audience significantly. Geographically, they focus on dense urban and suburban areas globally, but they do adapt locally.
How so?
Well, offering cash payment options in some countries where credit card penetration is lower, or using different vehicle types like motorbikes in congested cities in Asia, for example.
And the absolute backbone of all of this is the technology platform itself.
Oh, absolutely. That is the key asset. It's a complex stack. Sophisticated GPS and mapping, those intricate matching algorithms we talked about, robust payment processing systems.
And a lot of data science.
Huge amounts. Major investments in data analytics and machine learning. This tech helps them forecast demand, optimize pricing in real time, detect fraud, personalize the user experience, and just manage operations at an immense scale. They even had a dedicated Uber AI division for a while.
And the grand ambition seems to be creating this super app, right? One platform for everything on demand.
Yeah, that's definitely the stated goal, to become sort of indispensable in your daily life for moving people and goods. The idea is to leverage that strong brand recognition and massive user base across rides, delivery, freight, maybe future services.
Creating synergies.
Exactly. Cross-promotion using data insights across segments. It aims to make the platform really sticky, keep you within their ecosystem. But as you can imagine, managing such a diverse set of operations and competing effectively against specialized players in each vertical, that's incredibly complex.
Yeah, speaking of competition, Uber definitely doesn't have these markets to itself.
Oh, far from it.
Yeah.
They are operating in incredibly large, dynamic, and frankly, intensely competitive markets across the board: ride sharing, food delivery, and freight logistics.
Can you give us a sense of the sheer size and growth potential of those markets?
Sure. The global ride-sharing market, for instance, was estimated at over $120 billion in 2024. Projections vary, but some see it potentially hitting over $1.1 trillion by 2037. That implies a huge growth rate, like an 18.6% compound annual growth rate, or CAGR.
Wow.
The U.S. market alone was around $28.5 billion in 2024, with steady growth expected there, too. Key drivers are things like urbanization, smartphones everywhere, demand for cost-effective convenience, and just the tech enabling it all.
In online food delivery, that feels like it just exploded, especially recently.
It really did, and the growth trajectory looks set to continue strong. Globally, that market was maybe $135 billion in 2023, projected to potentially exceed $317 billion by 2032. That's around a 10% CAGR.
Still very solid growth.
Absolutely. The U.S. market is currently over $31 billion, maybe heading towards $73 billion by 2033. Again, driven by convenience, huge restaurant variety, and the enabling tech. Trends now include expansion into grocery, retail, and that whole quick commerce, rapid delivery space.
So with markets that big, who are Uber's main rivals across these different segments?
It's a real mix, and it varies a lot by geography. In the U.S. and Canada, for mobility, Lyft is the primary competitor. They hold a significant chunk of the U.S. market share. One source cited around 24% in early 2024.
Okay.
Globally, you've got major regional powerhouses. DiDi is dominant in China and big in Latin America. Bolt is strong in Europe and Africa. Grab is the leader in Southeast Asia. Ola Cabs in India and some other markets. Plus, countless smaller local players everywhere.
And in delivery, for Ubereats, who are they up against?
DoorDash is the big one in the U.S. market. One source from 2022 gave them something like a 67% share, which is huge. Grubhub is another key U.S. player, though maybe less dominant now.
Right.
In Europe and internationally, you have players like Deliveroo, Just Eat Takeaway. Again, strong regional champions.
So with all that competition, how does Uber actually stack up? Are they holding their own in terms of market share?
Yeah, market share figures can be tricky. They depend on how you measure and the source. But broadly speaking, Uber is typically the number one and number two player globally in mobility, where it operates directly. And they're a very strong contender, often top two in delivery as well.
Any specific numbers?
Well, one source, CSI Market, for the 12 months ending Q1 2025, showed Uber with around a 49% segment share globally. That was compared to DiDi's 29%, DoorDash's 12%, and Lyft's 6%. But again, take specific figures with a grain of salt. They fluctuate. The point is, they're a major force.
Okay. So what are Uber's core competitive advantages then? What gives them an edge, that protective moat against all these rivals?
Several things. First, that powerful global brand recognition is huge. Second, the network effect we talked about, that dense web of users and providers, is incredibly difficult and costly for newcomers to replicate from scratch. That's a major moat.
The tech platform itself.
Absolutely. Their advanced technology platform and the vast amounts of data it generates give them an operational and efficiency edge. They can optimize better. Operating globally across multiple segments also provides economies of scale, diversification benefits, and resilience if one market or segment slows down.
And the multiple offerings help.
Yeah. Having diversified offerings, rides, food, groceries, freight, gives them multiple revenue streams and opportunities for cross-promotion. And importantly, their recently improving financial profile, generating profit and cash flow, provides the resources to invest, innovate, and potentially outcompete rivals.
How are they trying to actively differentiate themselves in this really crowded space?
A key strategy is leveraging that integrated platform. The super app vision is itself a differentiation play, trying to be the one-stop shop. They continue to invest heavily in technology, including those partnerships in autonomous vehicles. They're aggressively expanding into new, often higher-frequency delivery verticals like grocery and retail. Building out loyalty programs like Uber One is crucial to keep users engaged across their services. And increasingly, they're focusing on initiatives like Uber Green to appeal to sustainability-conscious consumers and meet regulatory pressures.
You mentioned a moat. How strong would you say it really is? Is it impenetrable?
Moderately strong, I'd say, but definitely not impenetrable. The network effects, the brand, The proprietary tech and data, those are powerful defenses, but the challenges are real and significant.
Like so.
Low switching costs. For both users and drivers, it's super easy to have multiple apps on your phone and just pick the cheapest or fastest option at that moment. Competition is incredibly intense, often leading to price wars that really erode margins. And critically, those regulatory risks, especially around driver classification, that poses a fundamental challenge to their entire cost structure. That's a big one.
And you touched on this interesting frenemy aspect earlier, exiting markets like China and Southeast Asia, but keeping equity stakes. Can you elaborate on that strategy?
Yeah, it's quite interesting. Instead of continuing these brutal, incredibly expensive cash-burning battles in massive markets where local players like DiDi in China and Grab in Southeast Asia were just incredibly strong and entrenched.
They took their losses.
Essentially, yes, on the operational side. They made the pragmatic decision to exit direct operations, but by keeping significant equity stakes, they retain potential financial upside if those market leaders continue to grow. It's a way to reduce their own operational risk and capital burn while still having some exposure to those huge markets. It complicates a simple us versus them analysis, but it reflects a pretty pragmatic global strategy.
And the multi-service platform itself, you mentioned, it's complex. Is it always a strength, or does it create challenges too?
It's definitely both. There are clear synergies, cross-selling opportunities like Uber One encouraging Eats users to also take rides, and using data insights across the platform. That's valuable. But it also means Uber has to compete effectively on multiple fronts, often against highly specialized companies. Think of DoorDash in delivery or established brokers in freight. It requires excellent execution across very different types of businesses, and it forces really careful decisions about where to allocate resources. The big question for them is always whether the value created by the integrated platform, the whole, is truly greater than the sum of its individual parts.
Okay, let's shift gears now and look at the financials. And again, just a reminder for everyone, this is about understanding the general trends, the conceptual picture based on data up to mid-2025. Not real-time figures and definitely not investment advice.
Right, absolutely. So historically, Uber was famous for just explosive revenue growth, high double digits, even triple digits, sometimes fueled by that rapid global expansion, but also equally famous for massive losses.
Right, burning cash.
Exactly. That growth has moderated now, but it's still strong. Revenue grew over 80% in 2022, then about 17% in 2023, and around 18% in 2024, getting close to $44 billion. Q1 2025 continued that kind of trend, up about 14% year over year to $11.5 billion.
Where's that growth coming from now?
It's driven by increasing gross bookings. That's the total dollar value of all the transactions on their platform, which comes from more trips being taken, more monthly active platform consumers, MAPCs basically, more unique users, and that growing higher margin advertising revenue within the delivery segment.
But the really big story, financially, recently, has been this transformation towards profitability, right? After all those years of huge losses.
Absolutely pivotal. This has been the major focus under Dara Khosrowshahi, shifting explicitly towards sustainable profitability. You see this clearly in the trend of adjusted EBITDA.
Okay, remind us what adjusted EBITDA is.
Right. It's basically a measure of core operating profit before you account for things like interest, taxes, depreciation, amortization, and some other costs. It gives a sense of the underlying business's profitability. And it's been consistently improving, grew 44% year over year in Q4 2024, and another 35% in Q1 2025. Strong upward trend.
And they've actually hit GAAP profitability now, too. What's the difference and why is that significant?
Yeah, hitting GAAP profitability is a really big milestone. GAAP stands for Generally Accepted Accounting Principles. It's the standard accounting framework. So positive GAAP net income means they are profitable according to those official rules, not just on some adjusted basis.
Okay.
They reported positive income from operations for the full year 2024, about $2.8 billion, and positive income from operations $1.2 billion, and net income $1.8 billion in Q1 2025. This is a major turnaround from years and years of losses. It shows the business model can generate real bottom line profit.
Though net income can bounce around a bit.
It can, yeah. It can be influenced by one-time items like changes in the value of those equity investments we talked about, their stakes in DiDi or Grab, for example. But the trend in operating income is positive. And if you look at the segments, mobility is highly profitable now. Delivery's adjusted EBITDA is scaling rapidly, moving towards consistent profitability. Freight is being managed for contribution, though it has been more volatile.
So are overall margins improving then? Are they becoming more efficient?
Yes. That's a key part of the story. You're seeing expanding adjusted EBITDA margins as a percentage of gross bookings. This indicates they're gaining operating leverage.
Meaning,
As the business scales up, those fixed costs, technology infrastructure, corporate overhead are spread across a larger revenue base. So each additional dollar of revenue contributes more to profit. And the growth in those higher margin areas, particularly advertising and delivery, helps accelerate that margin expansion trend too.
and what about free cash flow? That's often seen as a really key indicator of a company's financial health, right?
Absolutely. And this has been a very, very positive recent development for Uber. They are now generating substantial free cash flow. That's the actual cash left over after they pay for all their operating expenses and necessary capital investments, like maintaining the tech platform.
How much are we talking?
They reported $2.3 billion in free cash flow just in Q1 2025. Generating positive cash flow consistently like this gives them significant financial strength and flexibility. They can use it to reinvest in growth, manage their debt, or potentially return capital to shareholders.
They do still carry a notable amount of debt, though.
Yes, they historically used debt financing quite a bit. As of late 2024, early 2025, it was around $9.2 to $9.3 billion in long-term debt. But, and this is the key difference now, with growing profitability and strong cash flow generation, their ability to service that debt to make the payments is significantly improved compared to when they were burning cash.
So if you were following this company closely, what are the key financial metrics you'd really want to track?
Okay, I definitely keep an eye on monthly active platform consumers, MAPCs, and the number of trips those tell you about usage scale and engagement growth. Gross bookings gives you the total market activity happening on their platform. Then revenue, obviously, which is Uber's cut.
And profitability metrics.
Crucially, segment-adjusted EBITDA to see how each individual business line is performing profitability-wise. And increasingly, free cash flow is paramount. Its consistent generation is a major milestone and probably the best indicator right now of their underlying financial strength and sustainability.
It sounds like their whole approach to spending money, their capital allocation strategy, has shifted dramatically from that growth at all costs era.
Oh, completely. Under Khosrowshahi and their CFO, Nelson Chai, and now Prashanth Mahendra-Raja, it's become much more about disciplined capital allocation. That's the phrase they use.
What are the priorities now?
Reinvesting in the core platform, obviously. Making synergistic, smart acquisitions like that trendy Go deal seems to be. Investing in future growth areas like autonomous vehicles, but often smartly through partnerships to share the cost and risk. Strengthening the balance sheet, managing that debt. And yes, significantly, they initiated their first ever share repurchase program in early 2024.
What does that signal?
It signals increased financial maturity. It suggests they believe their shares might be undervalued, and they have enough cash flow to both reinvest in the business and return some capital directly to shareholders. It's a big shift in focus.
So that turnaround from basically burning through cash to actually generating cash, that's really the core financial narrative for Uber right now.
It is absolutely pivotal. For years, the biggest question hovering over Uber was, can this business model ever actually be profitable at scale? Now that they are consistently showing adjusted EBITDA growth, hitting GAAP profitability, and generating significant free cash flow, it fundamentally de-risks the investment story. It gives them much more control over their own destiny, financially speaking.
Okay, that makes sense. Let's maybe use the SWOT framework to kind of summarize things. Strengths, weaknesses, opportunities, threats. Starting with Uber's key internal strengths.
Okay. Well, number one has to be that globally recognized, very strong brand, almost synonymous with ride-hailing. Second, that powerful network effect we've discussed, really hard to replicate.
Right.
Third, the diversified platform itself operating across mobility, delivery, and freight gives them multiple revenue streams and some resilience. Fourth, their advanced technology and all the data they have gives them an edge in efficiency and personalization.
And the financials now.
Yes. Fifth, that improving financial profile, the recent profitability and free cash flow generation is a huge strength now compared to a few years ago. Sixth, they have experienced leadership navigating this complex landscape. And seventh, the underlying business model, driven by tech, is inherently scalable.
Okay, what about the flip side? Internal weaknesses. What challenges do they face from within?
A big one, and it's persistent, is the dependence on the gig economy model itself. This brings constant legal and regulatory challenges, especially around driver classification, and creates uncertainty about future costs.
That classification issue looms large.
It really does. Second, there's the history of unprofitability. Although they're profitable now, they have a huge accumulated deficit from all those past losses. And demonstrating sustained profitability across economic cycles is still key. Third, those reputational challenges from past controversies can still linger and require careful management.
It's a complex business to run, too.
Extremely. Fourth, the sheer operational complexity of managing a global multi-segment business is a challenge. Fifth, service quality can be variable because it relies on a decentralized network of individual partners, drivers, couriers, restaurants. And sixth, they still need to spend heavily on R&D and marketing to stay competitive and keep innovating. That's a constant cost pressure.
Okay. Opportunities. Where's the potential upside? The areas for growth and expansion?
Lots of potential here. One, expanding aggressively into those newer delivery verticals beyond just restaurants. Think groceries, retail, alcohol, pharmacy. That's a massive market opportunity.
Autonomous vehicles.
Two, yes, autonomous vehicle technology, particularly through those partnerships they're forming, could be transformative for their cost structure long term, though it's still a ways off. Three, continued growth in emerging markets where penetration might still be lower offers significant potential.
Anything else?
Four, growing that high-margin advertising business within delivery is a key lever for profitability. Five, expanding membership programs like Uber One to drive loyalty, frequency, and cross-platform usage. Six, growing their Uber for business offering for corporate clients. Seven, strategic partnerships and integrations. And eight, leveraging sustainability initiatives like Uber Green, which appeals to customers and regulators.
All right, and finally, threats. What external factors could really challenge or disrupt Uber's business?
Okay, top of the list, arguably, is intense competition. It's a constant threat across all their segments, leading to price wars, pressure on margins, and market share battles globally and locally.
And the regulatory side again.
Two, yes, regulatory scrutiny and changes. This is probably the most significant ongoing threat, especially that risk around driver and courier classification. A major shift there could fundamentally alter their cost structure and business model.
What else?
Three, economic downturns. Ride-sharing and maybe some delivery are discretionary spending, so they can be sensitive to recessions. Four, shifting consumer preferences, maybe more remote work long-term, impacting commute rides, or people shifting to other transport alternatives. Five, geopolitical risks and currency fluctuations, being such a global company.
Data security must be a concern, too.
Six, absolutely. Cybersecurity threats and potential data breaches are major concerns for a company holding so much sensitive user and partner data. They're a high-profile target. Seven, broader ESG concerns, environmental, social, and governance, particularly around labor practices beyond just classification, environmental impact, and ensuring strong corporate governance. These can lead to financial penalties, loss of trust, and operational hurdles if not managed well. And eight, maybe unforeseen technological disruption beyond just AVs.
It really feels like many of those SWOT factors are deeply interconnected, don't they?
They absolutely are. And that's what makes analyzing a company like Uber so complex and dynamic. For instance, that internal weakness of relying heavily on the gig economy model directly fuels the external threat of regulatory changes like driver reclassification.
Right.
Or the huge opportunity presented by autonomous vehicles could potentially mitigate driver costs, addressing a weakness and a cost pressure. But the development and deployment of AVs also represents a massive technological and regulatory execution threat if they don't get it right, or if regulations lag or become prohibitive. Understanding these interplays, how strengths might mitigate threats or weaknesses might exacerbate them, is crucial.
Okay, so looking ahead then, what seems to be Uber's primary focus for future growth? What are the key strategic initiatives?
The overall strategy now seems clearly focused on smart, sustainable growth, not just expansion at any cost like the old days. A core part of this is cross-platform integration, really leveraging the synergies between mobility, delivery, and freight.
Making the whole greater than the sum of the parts.
Exactly. You see this reflected in their leadership structure, aiming to unify the pillars. And initiatives like Uber One are key, encouraging users to engage with multiple services, which ideally increases their lifetime value to the platform.
Autonomous mobility is still a big part of that long-term vision.
Yes, definitely, but the approach has matured significantly. They learned some hard lessons from their expensive in-house R&D efforts with the ATG unit they sold. Now, it's much more about strategic partnerships with leading AV tech companies like WeRide, NVIDIA, Momenta.
Why the partnership approach?
It allows them to integrate autonomous vehicles onto their network eventually, hopefully lowering operating costs and improving margins, without bearing the full, massive R&D burden themselves. It positions Uber more as an AV enabler and aggregator, leveraging its huge demand platform rather than being primarily the developer. It's a more capital-efficient and arguably lower-risk way to play the long game on autonomy. They are planning new city launches with partners.
Makes sense. And the delivery segment strategy, what's the focus there?
Two main things, really. Continued strong growth in the core restaurant delivery, meats, but also very aggressive expansion into those newer verticals we mentioned, grocery, alcohol, retail, pharmacy. That recent Trendyol Go deal in Turkey is a prime example of pushing hard into quick commerce.
In profitability.
Critically, yes. A major focus on driving profitability within the delivery segment, partly through operational efficiency, but significantly by scaling up that high-margin advertising revenue business. Ads are key to delivery's profit story.
What about Uberfreight? Is that still a priority?
It seems to be. They talk about developing freight as a strategic asset, using their technology to bring efficiency to the massive, often fragmented logistics industry. The goal appears to be building it into a significant, profitable business line over time, although its financial performance has admittedly been more volatile than mobility or delivery so far.
And internationally and on the sustainability front.
Emerging markets remain a key growth focus, trying to tailor services to local needs and exploring new entries carefully. And sustainability is definitely getting more attention, both for regulatory reasons and shifting consumer preferences. Initiatives like Uber Green, promoting EV adoption among drivers, setting zero-emission goals, these are becoming more central to their narrative.
Looking at what are some potential catalysts that could really accelerate Uber's growth or improve its performance significantly?
Okay. Well, the big one, long-term, would be the successful commercialization of autonomous vehicles at scale. That could fundamentally change their unit economics by drastically reducing driver costs.
Though that's still uncertain and likely years away.
Absolutely. More near-term, perhaps breakthroughs in scaling those new delivery verticals profitably, if they can really crack grocery or retail delivery efficiently, that could unlock massive new revenue pools. Faster than expected adoption of Uber One could be a significant tailwind, driving loyalty, frequency, and more predictable recurring revenue.
Regulatory clarity.
Yes, favorable regulatory outcomes, particularly something that provides clarity and a sustainable framework around worker classification, would remove a major overhang and uncertainty. Value-accretive strategic M&A, if they can integrate acquisitions well like they hope to with Trendyol Go. And continued rapid growth in that higher margin advertising revenue stream would definitely boost overall profitability faster.
What's the general feeling among analysts who follow Uber closely, say, around mid-2025? What's the sentiment?
Generally, I'd say it's cautiously optimistic. There's definitely optimism about the continued growth potential, especially in those delivery verticals and potentially freight turning a corner, plus the positive impact of the advertising revenue. The market has clearly reacted positively to the demonstrated shift towards profitability and strong free cash flow generation. You see many analysts with positive earnings per share (EPS) forecasts now.
But there are caveats.
Always. That optimism is tempered by a clear awareness of the execution risks. Can they scale these new verticals profitably? Can they continue to manage costs effectively? How smoothly can they navigate the complexities of international markets and potential AV integration? Valuation is also a factor for some analysts. Has the stock run up too much already?
And the risks we discussed.
Those key risks, the regulatory environment, especially driver classification, the intense competition, and macroeconomic sensitivity are consistently cited as potential headwinds or reasons for caution. So while target prices often indicate potential upside, there's also a clear recognition of downside risk if profitability stalls or competitive pressures intensify.
Okay, let's spend a bit more time drilling down on those key risks, especially the really significant ones, and how Uber is actually trying to mitigate them. You've emphasized regulatory risk, particularly driver classification, multiple times.
It really is paramount because it strikes at the core of their operating model, especially for mobility and delivery. We're talking about ongoing, often very intense legal battles and legislative efforts in numerous countries and states trying to determine if drivers and couriers should be classified as independent contractors or as employees.
And the impact, if they were widely reclassified as employees, would be
Potentially drastic cost increases. Think about it. If they became employees, Uber might be legally obligated to provide things like minimum wage guarantees, overtime pay, contributions to Social Security and unemployment insurance, potentially workers' compensation, paid sick leave, health insurance benefits, retirement contributions, all the things traditional employers typically cover.
Which are largely absent in the current contractor model.
Exactly. These are significant costs. A widespread shift to employee status could fundamentally alter the unit economics of the business, potentially forcing price increases, reducing driver flexibility, or requiring major changes to how they operate globally. It's an existential level risk they are constantly navigating.
And beyond classification, other regulatory risks.
Yeah, there's a whole suite. Issues around local operating licenses and permits in different cities. Compliance with increasingly strict data privacy regulations like GDPR in Europe or CCPA in California. Non-compliance can mean huge fines. And as they grow larger and make acquisitions, potential antitrust scrutiny becomes more of a factor too.
How do they try to manage this complex regulatory landscape?
It's a constant effort. They engage in dialogue with policymakers, extensive lobbying efforts, advocating for alternative solutions like portable benefits frameworks that might preserve flexibility while offering some security nets. They also have to adapt business practices to comply with local laws where necessary, even if it increases costs in certain markets.
Okay, moving to competitive risks. That intense rivalry you mentioned. How do they fight back?
Well, the reality is constant pressure on pricing, needing high marketing spend just to acquire and retain users and drivers, and these continuous battles for market share in every key region. Their main mitigation strategies are continuous innovation, trying to improve the product and user experience. Differentiation through things like Uber One or unique service offerings, investing heavily in their brand and technology to maintain an edge, making strategic M&A to consolidate markets or gain new capabilities, and a relentless focus on operational efficiency to keep their own costs as low as possible.
What about operational risks? Things like safety, managing the huge network of drivers.
Safety is absolutely critical. Any major incident carries huge reputational and legal risk. So they invest heavily in safety features within the app: emergency buttons, ride tracking, driver screenings, insurance coverage, partnerships with safety organizations. Attracting and retaining enough drivers and couriers is another constant operational challenge. They try to address this through initiatives focused on driver earnings transparency, better support channels, listening to feedback like those Project Boomerang efforts.
Service quality must be hard to control too.
It is, given the decentralized network. They rely on rating systems and feedback loops to manage quality. And cybersecurity is paramount. Protecting that vast trove of sensitive user, driver, and merchant data from breaches is a massive ongoing challenge. They invest significantly in security systems and partnerships, like with Zscaler, to try and stay ahead of threats.
Technological risks, beyond just AVs.
Well, even with AVs pursued through partnerships, the successful and safe integration of that technology into their existing network still carries significant execution risk, regulatory hurdles, and challenges around public acceptance. And fundamentally, the entire platform relies heavily on third-party infrastructure: GPS signals, smartphone operating systems, iOS, Android, payment processing networks. Any major disruption there could impact their service.
And the financial risks.
Yeah.
Beyond just achieving profitability.
Well, achieving sustained profitability across all segments and through different economic cycles is still the key challenge. Managing that significant debt load, around $9.2, $9.3 billion, remains important, although it's definitely less concerning now that they're generating strong cash flow. And as a massive global company, they're constantly exposed to currency fluctuations and macroeconomic shifts in different regions that can impact demand and financial results.
You mentioned ESG earlier, environmental social governance. Why are these increasingly seen as material financial risks for a company like Uber?
Because they're not just abstract ethical concerns anymore. They can have very real direct impacts on the bottom line and long-term sustainability.
How so?
Okay, take the S social, particularly labor practices. Beyond just the classification debate, it's about ensuring fair income opportunities, providing access to benefits where feasible or mandated, ensuring respectful treatment for drivers and couriers. Poor practices can lead to high driver churn, which increases recruitment costs, service disruptions due to protests or strikes, regulatory intervention forcing changes, negative press, and potentially successful unionization efforts, all of which have tangible financial costs.
And environmental.
The E. The sheer carbon footprint of millions of vehicle trips daily is a significant environmental impact. This leads to regulatory pressure, like low-emission zones in cities, potential carbon taxes, and growing consumer demand for greener options. So, investing in things like Uber Green, promoting EV adoption among drivers, and setting ambitious zero-emission goals isn't just good PR, it's becoming a business necessity to mitigate regulatory risk and maintain market access and brand image. Poor environmental performance could lead to fines, taxes, or operational restrictions.
And governance.
The G. Given Uber's troubled past with governance issues under Kalanick, maintaining strong corporate governance, ethical leadership, board oversight, and transparency is absolutely critical to maintaining investor confidence and avoiding future scandals. Governance failures can lead to massive fines, lawsuits, loss of executive talent, and severe damage to the brand and stock price. And data privacy falls under ESG too. A major breach resulting from weak governance or controls can lead to enormous financial penalties and an irreparable loss of user and partner trust.
So addressing these ESG factors isn't just about doing good, it's core risk management.
Exactly. It's increasingly seen as prudent risk management that directly impacts financial performance, brand reputation, regulatory standing, and ultimately the long-term value of the company. Investors are paying much more attention to this now.
Okay, so let's try to bring this all together. Uber's journey has been pretty incredible, right? From that single-service disruptor shaking up the taxi industry to this sprawling, diversified global technology platform covering mobility, delivery, and freight.
It's been a fascinating transformation, yeah. And their core strengths are clear. That incredibly powerful global brand, the hard-to-replicate network effects, the sophisticated underlying technology platform, and now, critically, that improving financial performance profile and more disciplined, experienced leadership.
But the challenges haven't gone away.
No, definitely not. They remain significant and persistent. Navigating that incredibly complex global regulatory landscape, particularly that huge looming question around driver classification, managing the intense competition across every single segment they operate in, and just executing flawlessly across such a vast, complex global operation, it's a high-wire act in many ways.
The key narrative thread, though, over the past few years really seems to be that pivotal strategic shift away from growth at all costs towards sustainable, profitable growth and actually generating free cash flow. It feels like a maturation of the company.
It really does signal that. So for you, the listener, understanding Uber today means recognizing a company that has navigated a pretty significant turnaround. It's now demonstrating more mature growth characteristics and much greater financial discipline than in its earlier years. It offers exposure through its tech platform to some very large and rapidly evolving markets: on-demand transportation, delivery, logistics.
So the investment profile feels different now, less purely speculative than it might have been a few years ago.
I think that's fair to say. It's still fundamentally a growth company leveraging technology in huge markets. But now it comes with a much stronger demonstrated focus on profitability and cash generation. However, and it's a big however, it definitely still carries notable risks. That regulatory dynamic is perhaps the most impactful and uncertain. Competition is absolutely relentless, and there are always execution risks, especially when scaling new verticals or integrating future technologies like AVs.
So it requires carefully weighing those significant market opportunities and Uber's competitive advantages against those very real inherent complexities and risks.
Precisely.
Ultimately, looking at Uber isn't just about analyzing an app on your phone. It's really dissecting this incredibly complex business model that operates right at the intersection of, well, cutting-edge technology, intricate global logistics, fundamental human behavior and needs, and constantly evolving regulation.
And that actually raises a crucial final thought, I think. Uber, as arguably the most prominent, globally recognized player in the gig economy, it's become a massive test case. Its journey, its successes, its failures, especially its ongoing battles over worker classification and platform responsibilities, these aren't just internal company issues. They are actively shaping the broader societal and regulatory debate about the entire future of work, the responsibilities of platforms, and how this whole sector should be governed moving forward.
That's a great point. So, in a way, understanding Uber, or even considering getting involved with the company as an investor or partner, it's partly about taking a view on the long-term viability, the regulatory acceptance, and the ultimate societal integration of the gig economy model itself.
Exactly. Their path forward, how they navigate these challenges, will continue to influence the narrative and the regulatory landscape for platforms just like them all around the world. It's a story with implications far beyond just Uber itself.
Fascinating stuff. As always, we encourage you, our listeners, to do your own thorough due diligence. Keep a close eye on Uber's financial performance, their strategic execution, the competitive landscape, and especially that continuously evolving, very impactful regulatory environment.
Yeah, make sure you understand both the significant potential upside and the complex challenges involved.
The content provided in this deep dive is for informational and educational purposes only and should not be construed as financial or investment advice. Investing in stocks carries risks, including the potential loss of principal. Listeners should conduct their own thorough research and consult with a qualified financial advisor before making any investment decisions. The creators of this content are not liable for any actions taken as a result of any information presented.
Thank you for joining us for this deep dive into Uber technologies.
We'll see you next time.